All right. Hey guys, welcome to the fundamental analysis. This is investing based on fundamentals, a guide to fundamental analysis. Today is Sunday, April 30, 2 o'clock, 2:05 actually. I am Nimish Pathak,
Yeah, I'm Ankur Pathak.
and we're going to conduct this seminar together. Ankur is helping me. He helped me with a lot of slides and is prepared with the content also. So what we have done is we have divided the content. Some slides I'll talk, some slides he'll talk, and then we can intermingle. But let's get started. So the first question, and I'm gonna turn off the Zoom bar so I won't be able to see who joined or not, or even a chat message. Okay, so now let's get started. So first of all, let's understand the financial analysis and the investing portion. This is a very common thing. The accuracy of financial analysis, that's the question. You can do so much financial analysis, but it's basically what you're doing is you're analyzing the past data and you're forecasting future, right? So it's very complex and subjective process. Lot of interpretation of data, economic indicators, and many times the results of the analysis are not accurate because there are a lot of other factors, right? Like market, industry trends, global economic conditions, war, and that kind of stuff. So, but it will definitely provide a valuable insights, right? You will get to know if the company is healthy or not, right? And what is the potential with the company. And that confidence comes from the data, looking at the past. And so what we do here is analyze the companies to understand the health and then take decisions. If you guys are not speaking, can you mute? I see somebody has a microphone open. All right. So always do your due diligence. Your research is needed, right? There's no one single Bible to explain that this is how you get the right numbers and this is how you take the decisions. No, you still have to do your diligence. You still have to do your research. And despite doing everything, things may not work out. That risk is always there with financial analysis, right? So whatever we explain here in this presentation doesn't mean that's the only way, but this is the core way to do fundamental analysis. All right, so if we zoom out and see what is our financial goal, this is like a 22-year-old kid coming out of college. That's a question someone may ask him or her that question. And the basic goal is I want to grow my wealth over time by investing in assets that have potential to increase in value. What could be those assets? Stocks, funds, bonds, and real estate. Things we invest that has a potential to grow. So then what is the success for that to happen? Well, the key is to develop a sound investment strategy that aligns with your goals, your risk tolerance, time horizon, how much time you have, how many years, how much risk can you take, what do you want to achieve, what are your goals. This is all done to make informed investment decisions based on the research. And that research part is what we're going to learn here. So our goal should be, if I have to summarize, our goal should be grow wealth over time by developing and executing a clear, sound investment strategy. All right.
So since our goal is to grow wealth over time, here are some strategies that you could use to accomplish that. So you can invest in good companies, diversify your investments, asset allocation, and be very disciplined and committed, cost efficient, and etc. But today we're going to be mostly focusing on how to invest in good companies. So some common questions about investing in good companies are, what makes a company great for investing in? And is the company overvalued or is it undervalued? And how much should I invest in a company? Or maybe how long should I stay invested in these companies? And many more. So as you all know, a stock's price indicates its current value to buyers and sellers, and the stock's intrinsic or true value may be higher or lower.
it boils down to the need to evaluate what is the true value of company or stock's value, right? Our goal is to find out what is exactly is that value of a company. And the challenge to us is, how do we evaluate a company's value? How do we do it? So there are two methodologies used. There are two ways I can forecast a company's value, right? And a company's value, when I say company's value, so for an investor like us, that boils down to the stock value or share value, right? So what are the methodologies to evaluate a company valuation? So one is technical analysis. And technical analysis is simply looking at charts and trends, and it predicts the stock's future price. It simply looks at charts. If the line is going up, then it predicts, is the line going to go up or not? Is it going to go down? So it's mostly short term. Could be for day traders, could be for somebody investing for 3 months, 6 months. So it's mostly for short term. It simply looks at the charts and the trends. And what it does, it looks at the past price movements, looks at the price trends, patterns, and it doesn't look at all at the intrinsic value. It looks at the stock's current market price or the past price and takes a decision. So the trader, so the people who use technical analysis for short-term trading are called traders. Traders simply look at the line charts, the candle bar charts, and decide when to buy and when to sell, right? So it doesn't look at the intrinsic value or true value of a company. Whereas fundamental analysis, this is the second methodology, where it is simply a method of evaluating a security or a stock or a company to identify the intrinsic value for long-term investments. So the first attempt it makes is to find what is actually value of that company. And then it uses financial data, industry trends, competition analysis. These things are evaluated. They play a significant role to determine the intrinsic value, right? So welcome to the investing based on fundamentals. This is where our fundamental analysis starts. It's part 1 of 3. All parts will be done today, but we'll break it down into 3 YouTubes. All right, so evaluating companies' intrinsic value. So the question is, what is intrinsic value? Well, intrinsic value of a company is basically an estimate of true underlying value of its stock or company based on the financial data and future growth potential and so many other factors. So what is the value of that company? What is the value of Apple looking at today's data and growth potential? What is the value of Amazon, right? That's the intrinsic value. And the goal is to find out, is the stock market currently overvaluing it or undervaluing it, right? The market price could be much higher than the actual value, intrinsic value, or could be low. So we are trying to use intrinsic value or true value as a benchmark. And then we will check whether it's overvalued or not. So the purpose of fundamental analysis is we are trying to identify the companies that are either undervalued or overvalued. And then we'll take a decision. Now, if you see this chart, you have value on the y-axis and time on the x-axis. And so this is the intrinsic value, the true value of a company. But the stock market will move this way. The stock price of that company will move up and down. So some portion, it is higher than the intrinsic value. Some people call it overpriced. And then this is a fair price. And then here, the value is less than the true value or intrinsic value, so it's underpriced. And someone owning a stock for many years or a long period of time, they may sell at the overpriced area or time. And someone who's willing to jump into the market is looking for underpriced period, right? So the decision is driven by the valuation of a stock. But the problem is we don't know the intrinsic value. What is that middle diagonal line, right? So question is overvalued versus undervalued companies. Again, overvalued stock is price is not justified because we look at the financial data, earnings outlook, the ratios, and we can say, yeah, this company is too high. The stock price is too high. It's overvalued. And usually the market price is greater than the intrinsic price. And undervalued is quite similar, where market price is less than perceived intrinsic value, right? So that's that. So as I said, when a stock price is overvalued, mostly people go short by selling it. When it's undervalued, they usually buy it and stay long. All right. So now this is how overall the picture is with the fundamental analysis. So we're trying to find out what's the company's intrinsic value by going through these 5 sections. The first is financial statements. Second is industry analysis. Third is management leadership, company profile, profit outlook, and then macroeconomic factors. So if we do research in all these areas, we will kind of get the idea on the intrinsic value. So starting with financial statement analysis.
So for fundamental analysis, there are 4 financial statements: income statement, balance sheet, cash flow statement, financial ratios, and analysis of all of that.
And usually what happens is these 3 statements are released during earnings call. The quarterly earning happens obviously every quarter. So these statements will be released 4 times in a year. In many companies, they even release the annual statements. That means a yearly statement. So we have access to all of this data. It is available on Yahoo, MarketWatch, all these financial screener companies. So when the earning calls happen, people will go, investors will go, they'll sit in the earning call, and then they'll go through the statements. They'll try to understand. And if the profits are less, and if the stock price is high, then on that day, the stock price goes down, right? Or vice versa. It could be the other way, right? So we'll go through these statements. So the first statement is the income statement. Now, this is the most important statement of all. And this basically shows companies' revenues and expenses over a specific period of time. And in the end, calculates whether the company made a profit or not. So if it's a quarterly income statement, then it's going to talk about revenues received in a quarter. So in this case, we have the annual report, annual revenues. So this company, this was released in the month of December 31st. In 2017, these are the numbers, 16 and 15, 3 columns. So in 2017, 229,000, this is in thousands, so this is millions. So 229 millions were received when they sold stuff. And then after all these expenses and tax and everything, the net income is $48 million, right? So that's what this statement is showing. So in 2015, the company had $53 million. And in 16, it went down to 45, and then it's coming up. So 2015 was really a good year for this company. That's a high level summary I can gather from this. And there are many other things. Like, for example, you can see here that the research and development, the R&D amount kept on increasing each year, so which is good. So that means they are planning new products, new tools, or they're improvising the product line. So this is good. Now, sometimes they overspend and they're the cost of a profit. So you have to read all that through this income statement. The next one is balance sheet. So the purpose of balance sheet is it's at the point in time, what is the company's position with assets, liabilities, and equity. So the balance sheet, when it's released in a quarterly basis in their earnings call, it is at that point in time. It's not for last 3 months. It's at that point in time. How is the balance sheet of the company? Right. So this is an example that they had $1,500 of assets and $1,000 of liability, and the equity was $500. So here they look for the debt. How is the debt? How is the liability? And some of the ratios will use these numbers to come up with a number. How big is their debt? How much assets they own? That kind of stuff. So balance sheet is helpful in mostly finding the debt ratios. Next one is the cash flow statement. This is also very good. So cash flow statement is basically checking how much cash is coming into the company and how much cash is going out for a specific period of time. And I have an example here. And then it says, okay, at the end of the year, did the company have more cash or not? Right. This is hard to see. So let's expand it. So let's just imagine that you are having a, say, a convenience store, 7-Eleven, for example. So when you started in January 1st, when you open up the store, you had 3,400 in your cash register. And this is for the month of January. So we are looking at a cash flow for the month of January, the first column. And say, and for the whole month, so you got $1,200 in operation, you sold $5,670 worth of sales. And so the total you got 6,870. Then you got some other, you sold a older refrigerator or something, you got 150 as a cash. So now you have 7,020. Then you have some expenses, right? You will some bill payment, some cash spending, and additional. Can you mute if you're not talking, please? Some repayment of current borrowing like loan payments, some liabilities. And so you had further expenses, and in the end, your total cash spent was 4,626. In the end, the net cash flow was 2,393. So in the month of January, this is the cash you had, but when you started, you had 3,400. So you add those two. So now in the end of the month, you have 5,796 cash with you. Then the next month, that money is carried over. So now the starting balance for February is 5,796 and so on. So this is how cash is flowing in, right? So cash is received, cash is spent, remainder is carried over to the next month. This is very important to see how much cash the company has on its hand. All right. So if something bad happens, it's the same as emergency cash that we have. If you lose a job or something, then how can you survive short term for 6 months? Same thing with the companies. Do they have enough cash on hand to pay off those emergencies? And sometimes do they have enough assets to sell if there's some emergency at that end? Can they sell some assets and gather the money, cash? So this also works in conjunction with balance sheet.